term life insurance versus permanent life insurance, which one's better, what's the difference, and which one is right for you and your family. In this video, we're going to dive into the difference between both, and I will share with you towards the end a very simple and easy formula to use to calculate out how much of each kind you would need to properly protect your family. First, let's talk about term life insurance. When you hear the word term, think temporary. It's only good for a certain amount of years. 10, 15, 20, 25, all the way up to 30 to 40 years today. So because of the fact that it expires, it's very inexpensive, which makes it easy for most people to own. Now, if you're in your late 20s, your 30s, your 40s, or your 50s, you're most likely carrying some debt that you need to pay off. Maybe you have a young family that is dependent on your income, or a spouse that needs your income coming in to survive. That's where term life insurance comes in because it gives you a lot of life insurance for a very small amount per month, making it very affordable for, again, just about anybody to own. And nowadays, it comes with a feature called living benefits, which means if you were to get severely sick or injured, and it's something that's considered critical, chronic, or terminal, for example, like a heart attack, stroke, cancer, maybe some kind of severe accident, you actually have access to the death benefit of the term life insurance while you are alive to pay for anything that you need. It could be medical expenses, it might be paying down your mortgage, it could just simply be putting food on the table for your kids. It's very flexible and you can use it for anything. So term life insurance is good in these types of situations. Now, comparing that to permanent life insurance doesn't ever expire. You have it forever as long as you're continuing to pay your premium. Now, that feature alone makes it more expensive to own than term insurance. So you typically don't see people owning more in a death benefit in a permanent policy than they do in term insurance because obviously term insurance is just less expensive. Now, there are 4 main different kinds of permanent life insurance. The very first one that came out a good 200-300 years ago today is whole life insurance. Been around forever, has a solid fixed cost of insurance, and grows a teeny tiny cash value behind that. Then they came out with universal life insurance, which allows you to have a little bit of a flexible premium inside. Then they came out with variable universal life insurance, which put the cash value component of the policy into the stock market, which, as you can imagine, didn't do so hot in the early 2000s and in 2007 and 2008. But since then, they have come out with a product called Indexed Universal Life Insurance. This came out in 1997, and it basically puts the cash value component of the life insurance policy indexed to the stock market, so you essentially can't lose money, but you can still earn when the market does well. The cost fluctuates in the VULs and the IULs, but long term, they're really designed that way to help grow a significant cash value component to it. So one unique feature of permanent life insurance, which I've already mentioned, is that all 4 kinds grow a cash value component to it. Now, there are a lot of nuances behind how that works. It's different depending on which type of policy you get, but just know that it's almost like a little savings account that's attached behind the life insurance that's working and growing and compounding and earning you interest that you actually have accessible to you all tax-free in the future through different types of policy loans. And these products also come with living benefits, like we mentioned for the term policy, but some kinds of permanent insurance can also come with long-term care, meaning you have access to that death benefit for an actual, real, true long-term care need. So as you can see, one type of insurance isn't necessarily better than the other. It just really depends on the need. Now to the formula that is going to help you figure out how much of each kind of insurance you need to protect your family. And that formula is called DIME. And DIME stands for debt, income, which is essentially your annual income times 10 years, mortgage, and education. So what you want to do is sit down and add up all of the big debts that you owe outside of the mortgage. Do we have student loans? Do we have car loans? Do we have credit cards, personal loans, business loans? All of that is going to go under the debt category. Then under income, it is your annual income. We recommend times 10 years because that is usually enough years for a family to get back up on their feet and continue to sustain the lifestyle with you no longer here if you were to pass away. Then obviously the mortgage, you can just write down how much you still owe on the mortgage if you own a house. And then education. This is more so for your kids. So if you have kids that you would love to help go off to college, whatever the average price of college is around where you live, times 4 years, times how many kids you have, would be what you would want to put in this spot. Now what we need to do is figure out which type of insurance is needed to cover and protect each letter of DIME. So for debt, I want you to add up everything you put in the debt category and think, Is your debt temporary or is your debt permanent? I hope it's temporary, right? So that can be covered with term insurance. Under income, is your income temporary or permanent? Can you live without income coming in? No, definitely not. Not in America, right? We need income coming in. So that's going to be needing to be covered with a permanent policy. Then, when you think mortgage, is your mortgage temporary or permanent? Most are temporary, right? And then when you think education, is that temporary or permanent? That should be temporary. So basically, what you can do is you would see that your debt, your mortgage, and your education could all be covered by a certain amount of term insurance, and your income should be covered by a certain amount of permanent life insurance. So if you go through and you add all of this up, you will get the exact number that you need, or what we call your insurable need, for each type of life insurance product, term, and permanent. This formula called DIME will help ensure that your family is properly protected. So if anything were to happen to you, they're going to be taken care of financially. And it also ensures that you're not going to overpay on a bunch of life insurance that you don't need. Now, if you want to know more about how different types of insurance products work, I've linked 2 videos here that will walk you through it. Make sure you subscribe so you don't miss another video teaching you how to save money on insurance and what to do with your finances. And I will catch you back here next week on YouTube.